Today, I'd like to introduce you to the 5 rules for successful stock investing. The author of this book, Pat Dorsey, is the head of stock research at the renowned American fund rating firm, Chinchin Corporation. He is responsible for stock analysis and ratings, boasting a wealth of experience in securities analysis. Dorsey's work in The True Rules of the Stock Market shares concepts and methods akin to investment giants such as Graham and Warren Buffett. This book will assist investors in swiftly establishing a clear framework for value investing analysis and directly applying it to their investment practices. If you are in the process of learning about investing, this book is undoubtedly a practical textbook. Even seasoned professional investors will find it highly beneficial. Let me break down the book into 4 sections for you. The first section delves into the core concepts of value investing. The second section discusses how to analyze a company's fundamentals. The third section explores the process of valuing companies. The fourth section outlines key investment points for major industries. The first section introduces the core idea of value investing in the stock market. The correct approach is the key to success. In the stock market, there are various investment techniques such as technical analysis, momentum investing, and quantitative investing. However, in the long run, most of these methods are not effective in helping you make money. There is one method, however, that has stood the test of time in the stock market for over a century, and that is value investing. Value investing, pioneered by Graham, has produced many outstanding investment masters throughout history. Warren Buffett, often referred to as the Oracle of Omaha, is a staunch advocate of value investing. Value investing can be summarized in one sentence: buying stocks is buying the value of the company. Investment involves assessing the company's value from the perspective of a company owner. The logic behind this investment is that stocks represent ownership in the business. If the company is well managed and continues to be profitable, its value will increase and its stock price will naturally rise. Peter Lynch, a famous American fund manager, once said that short-term stock prices may have no correlation with a company's performance. However, in the long run, a company's performance and its stock price are 100% correlated. So, how does value investing work? The author summarizes it with 5 principles. 1. Be prepared before you attack. 2. Seek companies with strong competitive advantages. 3. Invest with a margin of safety, buying at a low enough price. 4. Buy and hold for the long term. 5. Determine the right time to exit. First, thorough research is essential before buying. In other words, fully understand and research your investment target. This includes studying the annual reports of the target company and understanding the situation of other companies in the same industry. Take the time to prepare and minimize errors. The next step is stock selection. Value investing involves purchasing companies with strong competitive advantages, companies that can sustain growth. Additionally, investments should have a margin of safety, meaning they should be bought at a low price. More details on these principles will be explained in the second or third section. Once you've chosen the stocks to buy, since value investing is based on long-term principles, investors need to have a shareholder mentality. Patience and perseverance are required because, in reality, it takes time for a company's value to materialize. Finally, concerning long-term investing, does it mean you should never sell once you've bought a stock? No, there are 3 situations in which selling is advisable. The first is when you realize you've made a mistake. If the company you bought is not a good one, you should consider selling. The second is when a significant change occurs. For example, if the company's fundamentals deteriorate or if the stock price significantly exceeds the company's intrinsic value. The third is when you find a better investment opportunity or if the position in a particular stock becomes excessively large and needs adjustment. The author believes that, apart from these 3 situations, it's best to exercise patience and hold onto your investments. These are the core principles of successful value investing. Now, let's move on to the second section, how to analyze a company's fundamentals. Peter Lynch once pointed out that buying stocks without studying their fundamentals is like playing poker without looking at your cards. The chances of making money are very low. One of the biggest mistakes many investors make when choosing stocks is neglecting the fundamentals. They solely rely on stories and follow trends, often fantasizing about discovering the next Tencent or Alibaba. In reality, the likelihood of such discoveries is exceedingly small. The author advises investors to abandon these illusions, perform a comprehensive analysis of a company's fundamentals, and determine whether it's worth investing in. Fundamental analysis of a company comprises three aspects: analyzing the company's competitive advantage, scrutinizing its financial statements, and evaluating its management and operations. It may sound quite technical, so let's consider a more relatable scenario. Imagine a friend of yours runs a bakery and wants you to invest. What would you think? First, you'd consider investing the capital required for the bakery. You'd assess the market demand for bakery products and whether the bakery can genuinely attract customers. Secondly, you'd evaluate the bakery owner's competence and the quality of the team. Are there formidable competitors? In what areas does this bakery outperform its rivals? These are the same principles applied when analyzing a publicly traded company. It's just a bit more complex. However, the complexity can be simplified if we grasp the principles mentioned earlier. Those principles involve identifying companies with strong competitive advantages. In other words, the focus is on analyzing the competitive advantage of publicly traded companies. So, how do we go about this analysis? There are 4 steps. The first step is assessing the company's profitability. Historically, if you find that a company has consistently been profitable, it suggests that the company may possess some form of competitive advantage. To determine a company's profitability, look at 4 financial indicators: free cash flow, net profit margin, return on equity, and return on assets. Free cash flow is the amount of money a company generates from its production and operations. Part of it is used for reinvestment and operational expenses, while the rest is free cash that the company can use for dividends or stock buybacks. Warren Buffett is a staunch advocate of free cash flow. If a company's free cash flow is greater than 5% of its revenue, it may be akin to a money printing machine. Net profit margin is the ratio of net profit to revenue. A net profit margin consistently above 15% is a strong indicator of a company's profitability. Currently, the average net profit margin for listed companies in the domestic A-share market is below 8%. Return on equity, ROE, is the ratio of net profit to the company's net assets. Generally, if a company's ROE has exceeded 15% for several years, it typically indicates exceptional creativity within the company. Currently, the average return on equity for listed companies in the domestic A-share market is below 7%. Return on assets, ROA, is the ratio of net profit to total assets. In general, a range of 6% to 7% can be considered the average benchmark. If a company's ROA consistently exceeds this rate, it indicates a competitive advantage compared to peers. Currently, the average return on assets for listed companies in the domestic A-share market is only around 5%. These are the 4 financial indicators. In practice, these indicators can be used to quickly select stocks. Many stock analysis tools offer stock screening functions, and these benchmark values can be used as selection criteria. Thus, you can promptly choose alternative companies that may have competitive advantages. The second step in analyzing competitive advantage is to focus on where the company's profits come from. In other words, what makes the company profitable? This is essentially the study of the source of the company's competitive advantage. There are primarily 5 sources of a company's competitive advantage: product differentiation, brand superiority, cost leadership, high customer switching costs, and high barriers to entry. Let's begin with the first source of competitive advantage: product differentiation. In other words, a company's ability to offer a unique product that competitors find challenging to replicate. For example, think of Apple's Mac computers, iPads, and iPhones. In terms of system design and user experience, they stand apart from similar products, creating a distinctive competitive edge. The second source of competitive advantage is a strong brand. A well-established brand can captivate consumers' hearts over the long term, enhancing their sense of product ownership and willingness to pay. Examples include Coca-Cola, Nike, and Mutai, all of which owe their competitive advantage to robust branding. The third source of competitive advantage is cost competitiveness. This means the ability to provide the same product or service at a lower cost than competitors. Achieving this can involve process improvements or scaling up production to reduce costs. For instance, Southwest Airlines in the United States uses lower-cost aircraft and provides high-quality service without charging extra fees. As a result, their operating costs are 25% lower than other airlines, significantly altering the landscape of the U.S. airline industry. From 1980 to 2018, during Southwest Airlines' tenure as a publicly traded company, its stock price rose more than 200-fold. The fourth source of competitive advantage is high customer switching costs. This means that once consumers use a company's product, it's difficult for them to switch to another company's product due to economic or time-related costs. For example, a company manufacturing orthopedic medical devices sells artificial joints to hospitals. Surgeons typically need training, investing a substantial amount of time and effort in learning how to implant these products. However, products from different manufacturers often vary significantly. This means that if a surgeon switches to a different manufacturer, they would need to undergo retraining, substantially increasing the cost of switching. Consequently, hospitals are generally reluctant to switch orthopedic product manufacturers. The fifth source of competitive advantage is high barriers to entry. The author believes that companies with franchising, patents, and network effects have barriers that exclude competitors. It's easy to understand what network effects are. The more users you have, the more users you can attract. For example, Taobao and WeChat exhibit classic network effects. In the internet sector, network effects are the most typical barriers, often leading to a winner-takes-all situation. The third step in analyzing competitive advantage is to assess how long a company's competitive advantage can endure. We are currently in an era of rapid technological change. Generally, competitive advantages based on product differentiation tend to be short-lived. On the other hand, competitive advantages formed by low cost, strong branding, high customer switching costs, and high barriers to entry tend to have more sustainability. For example, the persistence of a competitive advantage in the electronics industry is much weaker compared to companies based on technology. In the electronics industry, competitive advantages based on technology are far less enduring. The final step in analyzing a company's competitive advantage is to study the industry it operates in. The industry's characteristics and developmental stage determine a company's growth potential. For instance, in some industries where a stable competitive landscape has formed, there might not be much room for newcomers. In contrast, industries that are still in a competitive stage may offer opportunities for dark horses to emerge. In summary, understanding how to analyze a company's competitive advantage involves 4 steps. The first step is evaluating whether the company possesses a competitive advantage, which can be quantified using certain financial indicators. The second step is assessing the sources of the company's competitive advantage, summarized in 5 categories. The third step is examining the duration of the competitive advantage, considering the pace of technological change. Finally, the fourth step involves analyzing the industry in which the company operates to determine its growth potential. Now, let's consider this question. If we've analyzed a company's fundamentals and identified it as a good company with a competitive advantage, at what price should we purchase its stock? To answer this question, we need to value the company, which is what we'll discuss in the third section. One of the common mistakes investors make is overlooking valuation. Without knowing how much a company is worth, you cannot determine whether its current stock price is high or low, expensive or cheap. You also cannot gauge the potential risks and rewards of your investment. The author of this book advises investors not to rely on guesswork or hope that someone will take over their shares in the future. Therefore, even when buying the stock of a good company, it's crucial to consider whether the purchase price is reasonable. To do that, you need to value the company. Valuation primarily involves two methods. The first method is the discounted cash flow (DCF) approach to future free cash flows. Renowned American investment theorist John Burr Williams explicitly stated in 1938 that the value of a stock equals the present value of a company's future cash flows. So, what is discounted cash flow? Simply put, it's a method of discounting every dollar a company is expected to earn in the future. This discount is then added to the intrinsic value of the corresponding equity. The size of the discount depends on two factors. First, the interest rate, and second, time. The later you receive cash flows, the greater the discount. Of course, accurately calculating a stock's intrinsic value can be more complex. Even the Oracle of Omaha, Warren Buffett, admits that he cannot value many companies because understanding how much cash flow they will generate in the future is a variable question. However, that's okay. As Warren Buffett said, in investing, being roughly right is better than being precisely wrong. Start with a rough estimate. Based on the principles of cash flow discounting, three things are easy to discern. First, the more a company earns, the higher its valuation. Second, the longer the profit duration, the higher the valuation. Third, the lower the risk a company faces in its future operations, the higher its valuation. Hence, in practical investing, these three factors determine a company's valuation. Of course, if you want to calculate them more accurately, many stock software tools can perform these calculations today. But remember, it's essential to discount the valuation results, often referred to as setting a margin of safety. This is done to avoid the error of being overly optimistic and overestimating stock prices. In the author's Jusha company, a safety margin of 20% is typically set for stable companies with strong competitiveness. For high-risk companies lacking competitive advantages, a 60% margin is applied. For most enterprises, a 60% to 70% discount in valuation is more appropriate. That's the first method of valuation. Now, let's introduce the second method, using relative valuation indicators to estimate a company's value. Common relative valuation indicators include price-to-earnings ratio, P/E ratio, price-to-sales ratio, P/S ratio, and price/earnings-to-growth ratio, PEG ratio. Here are the key indicators used later in this text. Two ratios, price-to-earnings, P/E ratio, and price-to-sales, P/S ratio. The price-to-earnings P/E ratio is calculated by dividing the stock price by earnings per share. For instance, if the stock price is $50 and the earnings per share is $2, the P/E ratio would be 25 times. There are two ways to consider the P/E ratio. One is to compare it with industry averages or market averages. Generally, if the P/E ratio is lower, it suggests that the stock's value is relatively underestimated. However, this is not absolute. In investment practice, the relationship between the P/E ratio and a company's risk, growth potential, and capital requirements is essential. Higher growth and higher risk companies tend to have lower P/E ratios, while lower growth and higher capital requirement companies tend to have higher P/E ratios. Therefore, one can intuitively think that stocks with lower P/E ratios are undervalued and those with higher P/E ratios are overpriced. The second way to use the P/E ratio is to compare it with a company's historical data. For companies with a long-term stable core business, the P/E ratio is much lower than the historical average P/E ratio. However, it is crucial to consider the reasons behind this. It could reveal investment opportunities. In summary, the P/E ratio has the advantage of being intuitive and easy to calculate. It is generally suitable for companies with long-term stability. However, it is less effective for young companies with uncertain prospects. One of the most commonly used valuation indicators is the price-to-book (P/B) ratio. The calculation method for the P/B ratio is to divide the stock price by the book value per share. The P/B ratio is suitable for companies with a significant amount of fixed assets, such as capital-intensive manufacturing and financial industries. Generally, the P/B ratio has little effect on service-oriented and innovative companies. For capital-intensive industries and the banking sector, a P/B ratio between 1 and 2 is reasonable. However, most domestic banks have a P/B ratio below 1 due to market concerns about asset quality. When evaluating stocks using the P/B ratio, special attention should be paid to the actual net assets of the company. For example, if a listed company invests 1 billion yen to acquire another company and the book value of the acquired company's net assets is only 300 million yen, any additional expenditure of 700 million yen will be recorded as goodwill. However, if the results of the acquisition are not as expected, the goodwill may face impairment or liquidation in the relevant business area. In other words, if a business area accounts for a significant proportion of a company's net assets, the company's net asset value may be distorted. A distorted net asset value can lead to a distorted price-to-book ratio. For example, at the beginning of 2019, a batch of listed companies in the domestic A-share market recorded significant impairment losses in their business areas in their annual reports. This resulted in massive losses in company performance and a steep drop in stock prices, causing negative impacts on the market. When evaluating a company, it is best to use various valuation methods to comprehensively analyze the company. This way, you can more comprehensively determine the company's value. Now, let's dive into the fourth section of the content. Key investment points for priority industries. In this publication, the author presents the results of research on 13 industries within the TNS sector, outlining the research approach and analyzing critical factors. In this part of the book, we explore how each industry creates its competitive advantage and how these strategies come into play. For the purposes of this discussion, we will focus on 3 major industries: pharmaceuticals, consumer goods, and banking. Pharmaceuticals. This is an industry where finding potential winners is relatively straightforward. The core competitive strength of this industry lies in its ability to research and develop new drugs. Drug development is time-consuming, expensive, and can often result in failures. However, pharmaceutical companies that lack research and innovation capabilities have limited long-term growth prospects. Therefore, when investing in pharmaceutical companies, it's crucial to select those with a sustained capacity for research and innovation. Additionally, it's advisable to closely monitor the development of government healthcare policies when investing in the pharmaceutical sector. Changes in healthcare insurance and pharmaceutical policies can significantly impact the competitive landscape of the industry. The investment advice provided by the author, based on research into the U.S. pharmaceutical industry, is also applicable to the analysis of investments in the Chinese pharmaceutical industry. Consumer goods. When evaluating potential investments in the consumer goods industry, there are 4 key characteristics to consider. First, market share. Generally, larger companies with higher market shares are more likely to maintain their leading positions. Second, free cash flow. Mature consumer goods companies often generate substantial free cash flow, allowing them to pay dividends and engage in stock buybacks, making them stable investment options. Third, branding. Consumer goods companies with strong brands have a competitive edge. Examples include Coca-Cola, PepsiCo, Nike, and Adidas. Fourth, innovation. Pay special attention to companies that can consistently innovate their products while holding the largest market share in innovative products. Examples include Geely Automobile and Apple Inc. Banking. The banking industry plays a crucial role in both domestic and global economies, attracting significant attention from investors. Warren Buffett, for instance, has maintained a medium-sized position in bank stocks over the long term. Profitability models in banking can be simplified into two categories. One involves banks obtaining funds from depositors and capital markets, which are then loaned to borrowers, earning interest rate differentials. The other category involves various intermediary fees. Risk management is at the core of the banking industry, encompassing three types of risks: credit risk, liquidity risk, and interest rate risk. Successful banks share four primary characteristics: a robust and stable capital base, strong risk tolerance, followed by high returns on equity and assets. If the return on equity remains consistently within the range of 15% to 20% and the return on assets falls within the range of 1.2% to 1.4%, it indicates the bank has good profit-making capabilities. Efficiency in management is another important factor, as reflected in the bank's operating expense ratio. A low cost-to-income ratio signifies high efficiency. Lastly, diversification in profit structure is essential. When assessing a bank's reputation, the audit ratio is a useful indicator. Now, this brings us to the conclusion of this book. Having explored the author's value investing principles and methodologies, we've learned how to address the challenging question of how to choose stocks for investment. The author advocates the following key points for investors. 1. Analyze a company's fundamentals and intrinsic value based on the principles of value investing. 2. Understand the competitive environment of the company. 3. Make rational investment decisions. 4. Consistently follow the analytical framework outlined in this book. By summarizing these experiences, you can reduce mistakes and have the opportunity to become a successful investor. In this sense, the real rules of the stock market are laid out. This is a book that can change the fate of investors. In conclusion, the author advises investors to be selective, employing a pick-and-choose strategy. In other words, avoid speculating on whether prices have reached their peak or bottom. As the author reminds us, after tracking thousands of funds over the past 20 years, no fund has consistently been correct in market timing. Thus, investors should rely on fundamental and valuation analysis. That concludes our discussion of the 5 rules for successful stock investing. If you found this video helpful, please don't forget to like and share it with your friends. Also, remember to click the subscribe button and enable notifications so you won't miss any future videos. Until next time, take care.